tuned now for the second hour of the Closing Bell with Kelly Evans and Company.
And welcome to the Closing Bell. I'm Kelly Evans. It's 4 o'clock on Wall Street. Here's how we're finishing up another pretty strong session, you have to say, with the Dow up almost 1% or 160 points today. The NASDAQ adding 1.3% as its bounce off yesterday's lows continues, adding 52 points. The S&P 500, the broad market gauge, up about 19 or 1%. So let's get right to it now with today's panel to digest all of the news and what's moving these markets. CNBC contributor Michael Yoshikami is here. Enter Stoltmann from Stoltmann Law Offices in town. Our own Michelle Caruso-Cabrera and Dominic Chu. Great to see all of you guys. Google shares are starting to move. The company out with its earnings report. Let's talk through the numbers. Josh Lipton joins us now. Josh?
Yeah, Kelly, Google just reporting. Remember, the street was looking here for 641 on revenue of $15.54 billion. Google reports 627 on $15.42 billion. So a miss there on the bottom and the top. Just digging through the numbers here, paid clicks were up 26%. That actually is a bit shy of what this was. CPC's cost per click, or the average amount advertisers are willing to pay when we click on ads, those were down 9%. That's about in line with what the street was looking for. But again, Google here missing on the bottom and the top. Kelly, back to you.
Thank you, Josh. Wanted to get some reaction here from Victor Anthony. He joins us, Managing Director at Topeka Capital Markets. Victor, you surprised?
Yeah, well, those numbers are in line with my estimates. So those numbers are good as far as I'm concerned. There were a lot more aggressive numbers out there on the street. So Google missing those aggressive numbers, I think, will likely take the stock down. That's the reaction you're seeing today. But these are still solid numbers. Paid clicks growth of 26% is a solid top-line number for Google.
Okay, so I'm just thinking through this here for a second. The shares are moving lower by about 5%. You're saying that what happened was that the rest of the street was just too high, too optimistic here, but that you still see good signs?
Yes, they came in line with my estimates. I was at 6.27. I had about 26% CPC growth, but there were a lot more aggressive numbers as far as cost per click growth, as well as paid clicks growth as well.
So you're not worried about the fact that their average cost per click was down 9% year on year?
Well, that's actually better from the fourth quarter. It was down 11% in the fourth quarter. So trends are moving in the right direction.
Yeah, but it's still falling.
Yeah, it's still falling because of the
less
mix.
Bad, exactly.
The mix of queries. A lot of close to 40% of queries on Google are on mobile, where the CPCs are lower, but the gap is closing over time.
But this is exactly the problem, right, with tech stocks, in that the high flyer beta stocks have such incredible expectations that you've described. Sounds like you were a bit more conservative, correctly so, but these high expectations.
But was Google supposed to be one of the high flyers? No. I mean, I thought that this was kind of like
it has been.
Well, it still trades at like 30 times trailing earnings.
Yeah, but Tom, that's nothing.
But I guess my question is, what are the mobile growth numbers? Because isn't that where the future basically is for Google? And I still haven't heard what those numbers are, or what they're going to be. And if those aren't growing, I think that's really problematic for the company.
I see Tim Seymour joining us here as well. Tim, hello, welcome.
The way I see it is the rest of the world growth for them. The rest of the world is 46% of their business. This is a place where they're going to surprise on the upside. But if you're looking at valuation and what's the last 2 weeks been about, it's been rotation out of growth into value within the tech space. This is as much value as you're going to find, and scale matters. For all the mobile moves that Facebook and Twitter are trying to make, Google is already there, and this is a place I'm much more comfortable.
What about the core issue that our analyst was talking about earlier? Yes, they're migrating more and more to mobile. That's important. But you get paid less for mobile. They're going someplace where they get paid less.
Although, what I would say...
That sounds like a bad recipe for a stock.
Well, I'll tell you, Michelle, when I look around the rest of the world, though, when you look at how they're monetizing mobile, and the best way to get into e-commerce and emerging, for example, is through search. And that's where their paid clicks are a lot higher. Everyone knows that the CPC is something that's been a trend that's been bothering this company for 2 years. It didn't matter 3 weeks ago. It didn't matter 3 months ago when people were pushing this thing to all-time highs. I don't think that that's really what you should be focused on. I think you should be focused on top-line growth and scale in mobile, which these guys have.
Okay, Victor, by the way, are you wearing Google Glass?
I am.
Okay, stay right there.
Wait a minute.
We've got a lot more discussion.
That guy is a bull, because that's not a good look.
In the next block, just hold that thought for right now, because we've got a couple of other big names to hit right now. In fact, we've got the numbers on American Express. Mary Thompson joins us now with those. Mary?
Hey there, Kelly. American Express beating on the bottom line, missing on the top line. Earnings of $1.33 a share, 3 cents ahead of expectations. Revenues a little light, though, coming in at 8.26 million, and that was slightly below analyst estimates of 8.3 million. Couple of highlights. The company's CEO, Ken Chenault, saying card member spending was up 6% globally, and that's 7%, an increase of 7% on a currency-adjusted basis, a little bit lighter than the company's long-term goals on that levels. Consolidated provisions for losses were up 17% from last year. Consolidated expenses were down 1%. The effective tax rate was up slightly to 35% from 33%, and the company's ROE was 28.3%. That is up from 23.2% a year ago. I'm going to be listening to the conference call at 5 o'clock, and we'll have the details from that coming up on Fast Money. But again, a beat on the bottom and a miss on the top for American Express. Back to you, Kelly.
Yeah, Mary, thank you. For now, the shares, guys, are moving lower by about 1% after hours. American Express, not a different way of looking at the financial space, or maybe the consumer, maybe enterprise. Important different points of light to pick out. But Andrew, any reaction? I mean, look, we're now 2 for 2 with companies moving to the downside. It's starting to look a little bit like yesterday.
Yeah, I don't know. I mean, I just like the stock. I mean, if you take a look at the way the economy is right now, it seems like this is a sweet spot for a company like American Express. They have those premium customers that are paying their bills on time. This just seems to be the Goldilocks economy for American Express. I like it as a long-term play.
Welcome back. The earnings news on Google and IBM still settling in here on Wall Street. Joining our group now is Ross Gerber, the CEO of Gerber Kawasaki. He spends some advertising dollars on Google, Ross, but apparently not enough lately.
Well, I guess I'm single-handedly responsible for helping them, huh?
That's right. Well, what I mean is that their shares are moving lower. There's questions about the extent to which they're going to monetize as people move their ad budgets to mobile from traditional desktop. What do you think about the results here and about the shares being off 5%? Would you buy them here?
Well, first of all, let's talk about how they're moving from traditional desktop to mobile. That's not a profitable move for Google. Desktop ads have a higher premium than mobile ads, and they've changed their ad platform so that you almost have to advertise on mobile now unless you adjust it. And with those changes, you're going to see some lower numbers in some places, but it's smart longer term.
But isn't a big issue that the traffic acquisition costs are skyrocketing? I think they're going to pay Apple about $1 billion this year in order to advertise on their mobile devices. Isn't that getting bigger and bigger and bigger, and isn't that going to be a problem for Google in the next couple of years?
Actually, no, I think that traffic acquisition costs are actually stable for Google. So I don't have an issue with that. And with reference to the mobile shift, users are moving over to mobile, and Google has come up with a solution. And advertisers are using it. Yes, the pricing on mobile is at a discount to desktop, but that pricing is collapsing, and you're seeing that almost every single quarter.
Is it fair, Victor and Ross, to strip traffic acquisition costs out of these core earnings numbers? We've seen that with Yahoo. We've seen that with Google now. Why do it that way?
Well, you got to strip those costs out because it's really net revenue to your company, and it's just like any business. There's a certain cost to getting that revenue, and what really counts is the revenue in your business.
Isn't it a cost of doing business?
Yeah, exactly. But really, what matters is how much money comes into Google, and let's not forget, this is a mobile world. I ran some Facebook ads the other day, and you know what percentage of my clicks were from mobile? It was 100%. Like, wow. It's crazy how mobile's taken over the world, and Google, Facebook, Twitter, all these ad companies have to focus on that. But just to be said, there's nothing wrong with Google's ad business.
Tens of thousands of retailers around the world accepting Bitcoin, and venture capitalists have invested over $74 million into Bitcoin startups last year. This despite the costly blow-up of Mt. Gox. CNBC is looking at what's behind the movement driving the digital currency in a new documentary airing tonight on CNBC called The Bitcoin Uprising. Mary Thompson joins us now with more. What's in store, Mary?
Well, Kelly, boom, bust, or bubble, the Bitcoin faithful believe the digital currency will be a potent force in the global financial system, even as critics question its value and its viability. Well, wait a minute. There is a great part of the Bitcoin community. A lot of these entrepreneurs want regulation. They are actually seeking it because, as you mentioned, and that's a critical tension within the Bitcoin community. As you said, they're the libertarians that want nothing to do with any kind of government intervention in this digital currency. The entrepreneurs say if we don't have it, no one's going to adopt it, or I should say the general public is not going to adopt it, and it's going to die. And so the entrepreneurial force is trying to get at least some government regulation. Not a lot. They want them to use light touch there.
Should Bitcoin exist?
Well, yeah, I mean, Bitcoin should exist, but as Warren Buffett said, it's basically a dumb idea. When you have someone like Warren Buffett out there saying that, you got to give it some weight. I think Mt. Gox is simply the tip of the iceberg. I think there's going to be a lot more people people losing a lot more money.
It's my understanding that the legacy of Bitcoin isn't necessarily going to be the coin itself, but the frictionless transaction, right? It's the underlying architecture. It's the solving of the particular computer problem that is so brilliant that people talk about. And years from now, we won't be talking about Bitcoin, but we will be using some kind of platform based on this architecture.
Right. And not only will it be used, this is again what the advocates say, not only will it be used to transfer money, but other things. If you digitize contracts, things like this, the open source ledger will actually be able to verify it, validate it. And that too, that's what they call Bitcoin 2.0. So this really is just the start, they say. Eventually you can put a lot more information there that can be, as you sent frictionlessly, suppose, between two parties.
Welcome back. As we heard earlier from Kate Kelly, New York's Attorney General has subpoenaed a half-dozen high-frequency trading firms as it seeks detail about special deals they might have had with exchanges. My next guest says high-frequency trading is a form of cancer for investors. She's Honeybee Capital's Catherine Collins, author of the new book, The Nature of Investing. Our panel's here with us once again. But Catherine, it is great to see you. And Charles Schwab also described high-frequency trading as a cancer. How do you think about it?
Well, I think the Lewis book gave us a really great narrative of good guy versus bad guy, which is always really compelling. But when I analyzed high-frequency trading and its growth for the book, what I found was a more systemic question. What you saw in this environment was a piece of our trading system that grew from less than 10% of the market to over 60% of the market in a really short period of time, just a couple of years. And in a natural system, if you think of like a tree, it's as if the tree had a branch and suddenly the branch turned into Godzilla branch, just growing all on its own, completely detached from the rest of the organism. The only time you see that kind of growth in nature is with disease. It's with viruses, cancer.
Or the early years of Google.
Oh, come on. No, I don't think so, Michelle. That's not true.
Growth is evidence of bad. That's totally specious.
It's not growth in and of itself. It's the question of what that growth is attached to. And for a healthy system, you need growth in conjunction with development. So the reason Google was growing is that the whole ecosystem around it was growing as well. We had internet bandwidth growing. We had demand for the services they were providing growing. We had information that supplied the whole system that was growing. With high-frequency trading, it really was a pretty divorced growth from the rest of the system. If you look at the rest of the market, it really didn't grow at all during that same period.
Bad. And that's
it makes it unhealthy inherently. It's a precarious
The fact that it's insider trading makes it bad. The fact that it's front running makes it bad.
That's a better core argument, certainly.
Well, okay, the front running thing we're not going to get into because you can make all kinds of arguments about whether it's legal.
Yeah, I don't necessarily agree with it, but it's a better core argument that it grew fast, so it must be bad.
But here's what I like about Catherine's approach, which is to say, I'm not sure anyone is going to be able to come to some sort of academic conclusion through studies for years and years for a time to figure out whether it is or isn't helping or hurting. But if you think about it as an analogous here as a cancerous system versus a healthy, sustainable growth one, I'm all right with using with that kind of analogy. That can help you think about whether it's something that contributes to the greater good or not.
I think Michelle, what you're missing here is the characteristics of the growth, not the growth itself. You can have fast growth that's really healthy, but when you have growth that is not matched by growth in the trading partners, growth in the regulatory system, growth in the other technologies that all interface with HFT.
Growth in the regulatory system is really, really important. I mean, if we don't have that, God forbid.
Well, come on. I just don't understand what the big issue is about the regulators investigating it. If it isn't insider trading, if there aren't any problems with it, so be it. But the fact that the regulators are investigating, that's a good thing. Sunlight is the best disinfectant. Let's see if it's as pure as what high-frequency traders say.
Welcome back. During this Holy Week, a holy cow comment from former New York City Mayor Michael Bloomberg. In an interview with the New York Times, Bloomberg spoke proudly of his work advocating for gun safety and healthier lifestyles for New Yorkers and said he has little doubt about what lies ahead for him. Quote, I am telling you, if there is a God, when I get to heaven, I'm not stopping to be interviewed. I am heading straight in. I have earned my place in heaven. It's not even suffered through these negotiations.
He's going to go to heaven, but not for his stance on guns or anything related to that. He's going to go to heaven because he's given so much money to so many good, needy causes. And look, it's probably sacrilegious to say it, but he's probably right, just for the wrong reason.
But now, wait a minute. If it's easier for a camel to get through the eye of a needle than for a rich man to get into heaven,
he's not getting in.
Quoting the scripture, I like this.
Well, if we're going to
works alone don't get you to heaven.
That's right.
It's supposed to be faith or something like that, isn't it?
Oh, by the way, also from Matthew is the line that your right hand is not supposed supposed to see what your left hand is doing. So as you do these good works, you're also not supposed to be trumpeting them and taking pride in them, because that's
it's a little
sinful in and of itself. So I mean, but I raise this all because Michael Bloomberg, I don't understand to what extent he's being serious and maybe sees this as a way of getting rid of all of his wealth to, grapple with those kinds of theological points.
He said it with a smile on his face, so hopefully he meant it as a joke.
Did anybody actually hear him say it? I mean, was he joking or was he?
I mean, they said he had a grin on his face when he said it. I can't imagine it was said any other way than that.
It does sound like a comment, actually, not that someone who is a disciple of God would make, but more what God would say. So,
what you would think that quote is something that God would say?
In other words, it sounds like a very God-like sort of stance that one takes. I'm God.
Are you hard God?
First of all, we're talking about a man.
He's got a direct line.
We're talking about a man right now, first of all, who served the city of New York for countless years, right, and now has a lot of stuff to do, a lot of time on his hands, a lot of things that he wants to focus on. He's got his own think tank. His philanthropic duties are coming back again. So maybe this
is just more Bermuda to go golfing in.
No, but there's actually, and I know we have to go, but here's a point that I think is underlying all this, which is to say, is it enough if you have been successful and wealthy and use that reputation and that wealth to give it all away and do these things with your name on a lot of things, or is the point to just not have gone in that direction in the first place? Like, are these really just vanity projects at their core?
No, I mean, I think he did it with the right intentions. It's just the fact that he's trumpeting it might not be the best thing for him to do.
All right, we'll go. Welcome back. We're unofficially calling this 5-word final thoughts. Take a look at Google. The shares are down about 4% off their lows after reporting earnings. But, guys, the key point here between Google, between IBM, is old tech is really coming under some pressure. This was supposed to be the port in the storm, Yoshikami.
Leading tech down.
So is that going to be the trade for tomorrow?
Yeah, I think it is.
All right.
You told us we only had 3 words.
Yeah. Already breaking my rules.
Buying opportunities, get in, long-term, great play.
Too many
for the stock market generally?
Yeah, for tech specifically.